Hey everyone, Douglas here, and welcome back to the MMT Macro Trader in this market recap. It's Monday, August 14th, 2023. All right, today, one of my Patreon members sent me this Twitter thread by Cox that is up on the screen right now and wanted to know, man, what's the risk here to this stealth liquidity squeeze? How do we view this from an MMT perspective? Is there really a big risk to markets? What the heck is going on here? So that's what we're going to discuss tonight. Is there a looming threat from the super secret stealth liquidity squeeze? Or is this just another chicken little, sky is falling, SVB blowing up, stocks are going to crash, TGA fill, stocks are going to crash? Is this just the next boogeyman that will never appear? Or is there some merit to what's actually being laid out here? That's the plan. Before we get rolling, if you're new here, hit subscribe. Turn that notification bell on, give it a thumbs up, all that good stuff. It would be much appreciated. But let's go ahead and get on into things. Okay, before we get into the nitty gritty though of kind of what the argument is here, maybe a summary first would make sense. Pretty much the Treasury is going to start issuing and has started issuing longer dated bonds. And effectively, the argument is some sort of duration risk might end up putting some sort of risk into equities. Maybe institutions are going to sell risk assets to take on these longer dated bonds, yada, yada, yada. Kind of the gist of the argument. Does it make sense? Not really. We'll explain why. Will this mark the top of the current rally that we've seen? Maybe, but not for the reasons that are being explained here. We'll get to why actually we might end up seeing a top now. But really, this sort of stuff, if you understand MMT, you'll really understand why the whole discussion over like reserves, over bonds, over treasuries, over the Fed and what the Treasury is doing is really, it's just really it's can it kind of be important? Maybe. Can it kind of have some impact on stocks? Maybe. But there are things that are far more important to track if you're actually trying to understand where stocks are headed next than what the hell the Treasury and the Fed is doing with reserves. Listen, in the grand scheme of things, in terms of, what the valuation is of any given equity, of any given stock, where stocks are headed, the ratio of reserves versus treasuries in the banking system ranks pretty damn low in terms of the impact of any sort of forward returns of the S&P or any given company. If anything, it's actually reverse what this entire argument is. QT is likely going to benefit banks. It's going to benefit the financial sector. It's going to make the financial sector more robust, not putting it in some sort of crisis liquidity mode. When the Treasury issues treasuries, long-dated treasuries, short-dated notes, bills, it doesn't matter. They're doing so because the reserves have already been spent into existence. They're doing it as a reserve drain. This is one of the insights that Warren Mosler came up with. This is really kind of the defining insight to what MMT actually is. The reserves come first, and the reserves aren't liquidity in any sense of the way that we would view liquidity from a kind of stock market perspective. Yes, reserves are liquidity for bank settlements. 100%. If reserves gets too low, there's not ample reserves, you can end up with a liquidity squeeze in the banking sector or in banks. They have to go get reserves from the Fed. That is something that can happen in a crisis that could potentially impact equity prices, right? You could get some selling that takes place because of a reserve kind of liquidity squeeze. Not going to deny that. However, the Fed's pretty much on that, right? For the most part, they understand how that operates, how to get on top of that, how to make it so it's not some sort of runaway sell-off in the post-Great Financial Crisis. They're aware of what's going on there. Day to day, it's not an issue. Day to day, the amount of reserves in the system or not in the system are not determinative of where stocks are going or not going. I don't want to say it's a red herring, but it is certainly a distraction for the data that you need to be paying attention to. And that is going to be primarily fiscal flows, number one. What is the government doing with spending? When it spends, that creates the reserves, that creates the net financial assets. That is the driver that creates the necessary income that will ultimately either become some sort of savings, some sort of financial investment in the banking sector, or it will, if it is spent, it will become the profits for the company that it is spent to or through, right? And then they will save it or they will spend it, and the cycle continues. Number two is going to be the bank flows. When a bank creates a loan, that creates new deposits, that creates demand, that creates, again, profits for companies, and that creates new financial assets in the private sector. Those are the flows that actually matter. What the heck is happening with bank reserves doesn't really matter. It doesn't matter. And I think that's kind of what maybe the main point I want to make in this entire video is it really doesn't matter. So to go a little bit deeper in the argument here, now we kind of have the base case for MMT, right? The correct framing for MMT. Again, remember, the reserves come first, then the bonds, and the reserves aren't, removing reserves isn't removing liquidity, okay? Banks really don't even want the reserves. In fact, that was the big argument after the great financial crisis. Well, wait a second. You're going to make us hold billions of dollars of reserves. You have to pay us interest on these reserves. That's what was requested by the banks and ultimately passed in 2008. That interest is now going to be paid on those reserves. The banks don't want the reserves. They want the bonds. But what about the argument that's being made in this thread? And I'll try and remember to link this thread below, that it's actually the long duration, the longer dated bonds, right? The treasuries. What about the 23-year treasuries, longer duration? Is that going to have any sort of impact? Well, I have it on good authority from the highest MMT authority possible that, number one, banks don't really like to hold and don't hold many long dated treasuries. One, they need to be part of the assessment, the managerial assessment. The regulatory assessment for banks. The acronym is CAMELS. The S is the sensitivity in the analysis. Yes, it's the sensitivity to interest rate changes, because of the fact that they don't want sensitivity to changes in interest rates. They're not going to hold long dated bonds. So what do they do with these when the Treasury issues them out? They sell them. They sell them to customers. And again, because when the government spends, when the Treasury spends, it creates the reserves that will buy the Treasuries back. Because of that, the reserves, the necessary money to buy these Treasuries, is already out there. And there are institutions that are out there that want duration. They have effectively it's their mandated objective to have a certain exposure to duration. That is what these funds do. And again, from the man's mouth himself, there is always a demand for this. It's always undersatiated. So there will always be a demand for long-dated bonds because of the institutional structure. And they're not going to shed assets to purchase these. They have the cash necessary to go ahead and purchase these. Now, maybe a fund or two might need to make space. Okay, so be it. But is it a threat to risk assets as a whole? No, it is not a threat to risk assets in the way in which the argument is being presented here. So what is the risk then to risk assets? The number one risk is what we just went over. It's government spending. The number two risk is a banking sector crunch, but not because of reserves, not because of quantitative tightening or quantitative easing, but because the banks decide not to expand their own balance sheet by creating new loans. It's the creation of the new loans that creates economic activity. It's the creation of the new loans that increases the asset prices. That is what we need to follow, not the reserve monetary plumbing stuff. Again, in a crisis, it's probably important to pay attention to see what the Fed is doing. But outside of a crisis, in a situation where we are seeing economic growth, it is the wrong place to look to find where risk might actually be for stocks. So, in summary, going over this thread again, I'll link it below. Hopefully, my little debunk here can give you the framework necessary to understand what's actually being said here, to understand the arguments that are being made, and kind of, I don't want to say debunk it, but just kind of deconstruct the argument through that MMT lens to understand what the risks actually are that are present to the current market conditions. So again, in summary, just to kind of summarize the whole MMT point here. So as you read through this, Yeah, you can have a grid, a lens to understand what's actually being said. Just to remember, number one, when the government spends, it creates the reserves necessary to purchase the bonds that it's going to issue. Okay, that's step number one. So the money's already out there. It's not a liquidity drain in any sense when QT takes place or when the Treasury issues bonds. The reserves are there to purchase them. That's step number one. Step number two, there is an appetite because step number one happens. There is an appetite for that duration. And risk assets aren't going to need to be shed to make room for that duration. Neither is there going to have to be some sort of major reshuffling on the bank's balance sheets to make space for this. It's just not what's going to happen. So what is the risk right now? Is there a risk right now to the overall equity space? Yeah, it is. It's what we talked about is the actual driver of the underlying price of stocks, fiscal flows and bank flows. And we are actually going to start to hit up against a bit of a fiscal ceiling here. September and October are, generally speaking, pretty low fiscal spending months. September, we're going to have a big tax drain. October, we're going to have an even larger tax drain. I'll probably talk about this later this week in a future update. But September and October, we'll have some big tax drains. That will certainly slow down the flow that we've seen through the beginning of this year. And then on top of that too, you also have spending kind of slow down as you head into October as the fiscal year runs down for the federal side of things. So those are the real risks that we need to be paying attention to, and that is why I tweeted out a couple weeks ago or a week or two ago that I think we're probably close to a short-term top because we are just near the end of that natural fiscal cycle, heading into kind of middle to late August here, and far more explains the situation in equities than some sort of super stealth sky is falling liquidity squeeze that is just kind of the next thing in line for stocks here. So I thought it'd be helpful to go over this. Let me know if you like this style of video, kind of debunking various things out there, giving some MMT takes. If it's helpful, if it is, I'll keep doing these. We can make this a slightly more common occurrence. But for now, that is all I have for tonight. So until next time, good trading, everyone. Oh, before I go, also check me out, patreon.com/MMT macro trader. If you like analysis like this, we have some amazing tools that we've now built. The dashboard is live. All of our deep learning tools are there, and our other kind of machine learning tools. And yeah, all the various tools that we use to understand where these flows are actually, where they're coming and where they're going. Access to those on a daily basis, and then multiple updates each week to try and understand what the heck's happening in markets. Again, all available patreon.com/MMT macro trader, link below, obviously. All right, that is going to be it. Good trading, everyone. We'll talk to you next time. Bye-bye.